Hello and welcome to NavTalk. NavTalk is proudly brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose. My name is Simon Prowse and I'll be your regular host for this series of podcasts. And I look forward to bringing you interviews and content on a broad range of topics that will be educational, inspirational, informative and at times fun. Well, hello everyone and welcome to today's NavTalk. Today's talk is entitled Finance Ready. My guest for today's talk is Sally of Sandcastle Finance. Sally is the owner and director of Sandcastle Finance, as well as being a joint venture partner of Navwealth Finance, who specialise in lending in all forms, from individuals through to corporations. Welcome, Sally.
Thanks, Simon. I'd rather call this topic Get Smart, Get Savvy, Money Matters.
Wow. And before we elaborate on that, Sally, it sounds very interesting. Let me give the audience a bit of your background. So you completed your HSC in 1989 and as part of that completion, you decided you wanted to become an accountant and started what they called a sandwich degree in those days with UTS, doing a major in accounting. In 1993, you graduated uni with a Bachelor of Business degree majoring in marketing, far from accounting. In 2005, you got a Certificate in Mortgage Broking, followed by a Diploma of Finance in 2011. In 2016, you completed your Professional Investment Advisor certificate, and in 2018, undertook your real estate licence. That's quite a resume, Sally. In 2009, you established Lifestyle Impressions and later changed its name to Sandcastle Finance in 2014. So it's quite a journey you've had to get here, Sally.
I have undertaken a lot of these courses because my passion is really around property, and that's how I got into mortgage broking. I realised accounting really wasn't for me, probably my first year, so I handed that over to you. Then I found out my real passion was around property. So that's sort of led me to the path of being a mortgage broker. So my whole aim at the moment is trying to get as many people into the property market as possible, because I've seen firsthand how it is a very good vehicle for wealth creation.
When it comes to property, Sally, you said it's your passion. Why do you think it is your passion? What is it about property that floats your boat?
I mean, I just love looking at houses, number one, but I like building houses, and also I've seen how it's a vehicle for wealth creation. So particularly I've been able to help people get into the market, and over the last 10 years in particular, we've seen massive growth of their wealth, and that also creates confidence in people and helps them achieve a better lifestyle for themselves and their families.
So in saying that, because the property is quite valuable and the amount of money a person can borrow against that value is quite strong, that allows them to create that wealth. Is that what you're saying around the leverage?
That's correct.
Okay, so let's get into the key points that you sort of segued into when we talked about finance ready. And you said it's not just about finance, or you said actually not being finance ready. It's about getting smart, getting savvy, and money matters. So take us for a bit of a journey there.
Well, when I started my own business, one of my niche target markets was actually helping some friends who were divorced get back into the market. And I believe, like, from that target market, a lot of people who have maybe been married for a while and then they've separated, they've actually let their husbands do a lot of the financial legwork. So in the Get Savvy, it's more about educating people about finance matters. Like, money does matter. Like, it's in terms of numbers, it's always important for you as your own person to know about numbers instead of sort of burying your head in the sand. So that's where the sort of Get Smart, Get Savvy tool comes from. It's about just knowing and not burying your head in the sand.
You're trying to educate a broader range of people, and not just the finance ones, but all of them, about being savvy with their money, getting to understand it and knowing what it really means. Is that?
That's correct.
So when it comes to home loans and borrowing money, there's some key factors in the process. Can you just take us for a bit of journey through that? And I think you've mentioned it started with serviceability.
That's correct. But I also just want to take a step back as well, because one of the other things is you need to have the right money mindset to be able to even think about borrowing money. So that is probably the very first thing we need to get people to understand, that owning up your own home is not just about your serviceability and the security. It's actually wanting to able to do it and getting in the right mindset about doing it.
So the desire of and the dream of having that house or a mortgage or a property is probably the key to this whole process.
Yeah, it's correct. It's about your mindset. Like, if you can get the right mindset of your why do you want to get into property, you can make it happen. A lot of people I see come to me and they say, oh, how can I possibly own your own home? But there are ways, if you have the right mindset, to be able to want to do this.
Great. So once we've got the mindset and we're ready to go, there's some key factors that we've got to look at when we're looking at this.
So to simplify things, I put it as the 3 S's. So the first step is serviceability. What serviceability ultimately is income versus expenses, but each bank can vary quite significantly in how much they're going to lend based on their parameters. So if we look at income, we can look at full-time income, part-time income, casual. We can look at rental income. We can some banks will even take trust distributions, even if they're from the family trust. We can look at Centrelink payments, and we can also look at child support. Just for example, with child support most banks will take income for child support only up to the age of 13, where there are some banks that will take up to 18. So that can significantly affect your serviceability. For example, if you do have child support payments coming from the government or your ex-partner. The other thing that can differ quite significantly from bank to bank is how they perceive rental income. Some banks might take 70% of the rental income. Some banks might take up to 90% of the rental income. Some people might be getting Airbnb income, for example, and some banks will only take 50% of that income, whereas others will take up to 80%. So it's really important to go to someone that has an idea of or has choices for you, because you might walk into a bank that you normally go to and they might not have the right policy for what your needs are at the moment.
So, Sally, importantly, every bank is different to the way they look at and address your income. And there might be a vast difference between one bank over the other on how much income that they'll assess based on your circumstances and the way you derive it.
That's correct.
So talk to us then about expenses. We've covered the income part.
Okay, so one of the things that came out of the Royal Commission a couple of years ago was how people dictated what their living expenses were. So the banks all, again, have different, what they call is a HEMS, which is basically the way they've calculated your living expenses. And again, some banks do this differently. The majority of the banks will do it based on your income and also the postcode that you live in and the amount of children you have, dependents, and also if you're married or single. So they have a set criteria, but each bank differs quite, again, vastly. It can differ by up to, say, $2,000 or $3,000 per month, depending on your situation, your income, your postcode. So, again, that will affect your serviceability. So that's the number one thing that banks look at, your living expenses. And then they expense things such as credit cards. So credit cards are actually expense at, say, 4% of the limit. So even if you don't use that whole limit, but the banks will actually do it at that limit. You might pay that credit card off every month, but according to the banks, they don't care. As long as they can see it on your credit file, they'll do it on that limit. So that, again, brings me to an important point. A lot of people actually don't know what cards, personal loans, and maybe leases they have on their credit report. One of the credit cards that seemingly comes up a lot is a Latitude credit card. These are cards that you can say get at the Harvey Normans, like if anyone's ever got any furniture, where, again, in their minds, they think it's an interest-free period, which it might be, but it does appear on your credit file as a debt. So the banks will expense this. So one of the first things I would always recommend is that you actually get a copy of your credit file. The way you can do this is either sign yourself up to Vita, or most brokers will have access to your Vita file we ask you for consent and we'll be able to show you a credit file.
So a Vita report gives us our score, our credit score. You're saying it's really important we do this before we apply for a loan so we understand what's actually part of our credit report, and that can be done through our broker or we can do it ourselves.
Correct.
Great. So we're down the road of looking at this serviceability. Is there any more factors that we need to consider as part of this, or is that pretty well covered it?
Well, that's pretty well covered it. So, I mean, as well, car leases, even if they're in your company name, some banks will want to expense them as an individual. So it's really important that you do have a choice of different banks. As I said, some banks don't include company debts, whereas other banks do expense it. But generally, when those banks expense it, they will add back things like depreciation and interest.
Okay. And if I've got a partner, I may not be married and I might be buying my first house, but I've got a partner and we're looking to buy it together, will they take our joint income, and how does that then affect joint expenses?
Well, that's exactly right. And again, there's probably only one bank at the moment that has a fantastic product called Property Share, whereas each individual in that situation is its own entity, whereas the majority of other banks is if you're on title together, you're joint and severally liable because you both have to be on the loan together. So most instances, the title has to reflect the loan.
Okay. So that's really important. So income and expenses have got to be worked out and thoroughly reviewed. Each bank will have a different approach to assessing that income and expenses. They're not all going to be the same. And it's important to shop the right one that works for your circumstances.
Correct.
So let's then get into the next part of the three S's, or you're calling the three wonderful S's in this regard. And what's that?
So the next one is security. So what that means is what you're able to put into the purchase. And this might come down to your savings. You might have a gift. You might have an inheritance. It's really the collateral that you are able to put into it. You may have another property, whether that's your own property or then we can go into security guarantee, which we have been doing a lot of in Sydney over the last couple of years because it is hard to save in this city, and a lot of people have a lot of equity built up in their properties that they are able to use to help their children purchase a further property.
So I'm allowed to help my children with equity in my property. So if I wanted to assist my child into buying a property, I could put up my property as security.
Correct. And the way the banks do it is as a limited guarantee. So how that works is if you're buying $1 million property or your child was buying $1 million property, the bank would need 20% security. And so you would put up $200,000 of your property as security at that point.
So the bank's still lending my child, in this your example, $1 million, but I'm putting up 20%, which is against my property as a security guarantee.
Correct.
Great. And tell us a bit about short-term things like gifts and inheritances and things. It's not money we've saved up. How does the bank assess those?
Well, in most instances, if you have a 20% deposit, the bank don't really care. It's becoming between 90 and 95% lends is when the banks want to see 5% genuine savings.
So they ask for genuine savings as in show us you've been putting the money away rather than I found this money from a family or something like that. They're going to want some proof that you can save money.
That's correct. But it's generally over... When it's under 80% LVR, they don't care too much because they've got a 20% equity already in the property. And as well, what banks are also accepting now is a rental ledger for the last 12 months to show that if you've been paying rent and you're going to buy your own home, that you've been able to pay the rent. So that can be included as genuine savings. And
I assume in your first section as well, when it comes down to serviceability, if you've been paying a lot of rent and you won't be paying rent when you're buying the property, that then comes into account your excess funds.
Correct.
Yeah, great. So that really helps because the rental market is obviously one where it makes it really hard to save as a first home buyer. I'd like to just segue from here, if I might, around this collateral part, because I think it's really important because this is our deposit. This is what really gives us a chance to put our foot in the door when it comes to property. Can you explain a little bit about the differing deposits? You've mentioned 80-20, 80% borrowing, 20% deposit, but that's sort of not a hard line. Is that fair to say?
Well, that's correct. So basically, most banks, if you don't have a 20% deposit, require you to pay mortgage insurance, which is a fee in case you don't, if yourself, it guarantees the bank against you defaulting on your loan. However, you would have read probably in the news recently about some of the grants that have come up because the government is very encouraging to help people get into the market earlier. And one of the major benefits they've introduced in the last couple of years is what they call the new home buyers scheme, in which the government is actually guaranteeing up to 15% of that deposit. So mortgage insurance is not applicable. And just in terms of numbers, that can save, like if you're up to the limit on what you can buy under this scheme, which is $900,000 in Sydney, that will save you up to, say, $40,000 in mortgage insurance.
So essentially, this new home buyers scheme is really a government guarantee around a deposit rather than anything. So it just avoids the need for mortgage insurance.
Correct.
Okay. And it's not actually money that the government are putting in.
No, correct.
Okay. And is there any others? Again, I'll home back in on this 80-20. It seems to be the piece de resistance or the line in the sand. If I'm a first homeowner or if I'm a returning homeowner, is 80% the hard line?
Well, again, there are some banks that have specials out currently. So they'll do 85% no LMI, which means that you only have to have 15%. There are banks that, again, the way I see it, there's probably three ways to get into the market if you don't have 20% deposit. The first way is using a security guarantor, which we've just briefly touched on. The second way is if you can qualify for the new home buy, one of the new home buyer schemes. And the third way is borrowing money from somewhere like a personal loan, which you are able to do with some banks if your serviceability is really strong, or obviously getting a gift.
Okay, there's a couple of others too that the government's recently introduced. I think there's a superannuation scheme up there.
Yeah, that's correct. So there's a few schemes on offer that come under this new buyers scheme. So, and they're only applicable to first homeowners or single parents as well. So there's two at the moment the government is pushing that help you avoid paying mortgage insurance and having the 20% deposit. So there is one that the government introduced again during COVID because they saw how hard it is to save for a deposit, and that is to enable first homeowners to take up to $30,000 out of their superannuation. They can only take $15,000 of that out at a time. So over a 2-year period, they could have $30,000 towards a new home. And the beauty about that is they're only going to pay 15% tax on any money they do take out of that scheme. But that's the cap at $30,000. Then, as I mentioned, we've got the first homeowner scheme. There is a new scheme that comes into place on the 1st of July, and there is going to be 35,000 places available from this 1st of July 2022, which is up from 10,000 places last year. And also within that, there is massive savings for first homeowners for stamp duty, because as we know, stamp duty is also another issue that has come to light in recent weeks. And so currently up until January this year, if you buy a property, say up to the value of $650,000, there'll be no stamp duty applicable. So you could apply for, say, one of these spots in the new first home buyer scheme. And if you can find a property for $650,000, you'll only be contributing that 5%.
I understand that there was a new initiative announced by the state government in trying to support stamp duty or reducing the cost of stamp duty when it comes to property.
Yes. So what I believe has happened is that as of January 16th in 2023, first homeowners when they're buying a property up to the value of 1.5 million will be able to choose whether they pay the stamp duty upfront or they pay it in installments over a number of years. What I believe is behind this is the government is trying to encourage people to have property as a more liquid asset, because there is so many industries behind property. So the people that get paid for a property transaction, say from a conveyancer to a mortgage broker to a real estate agent. So because stamp duties become such a high expense, what they are enabling from next January is letting people just pay in effect an annual land tax, which would be based on the value of the land. So just for an example, the average house in Sydney at the moment is, say, 1.12 million. A full stamp duty on that property would be $49,000. We can assume land would be around about the value of $750,000, and therefore the annual tax becomes $2,960. So it will allow people to get in and out of property faster if they just take the opportunity to just pay the annual land tax instead of paying upfront costs of $49,000.
And I dare say that upfront cost is quite an impediment if you're pretty tight on your savings and you're trying to get your 80%. So if you don't have the added cost of stamp duty in year one, rather you have it over the next 20 years, it's going to save you on that initial deposit.
Yeah, that's correct.
So the security piece out of your three S's, number 2, is quite an interesting one. It is quite rigid in terms of coming up with deposits and what it means. So we've got cash that was saved, and we've got security guarantees, and we've got gifts, and we've got inheritance, and obviously the rental that you mentioned, the rent offset. But then we've got this moving feast part, the part where the government with their initiatives and incentives can create security deposits in certain areas. So in this instance, the first homeowners, but then the first homeowners and the amounts seem to vary quite a bit, between 650 and 1.2 million. So is that a fair summation of the security piece?
Yeah, it is very confusing. The other thing I also wanted to talk about was the actual security of the property, because that can also vary from bank to bank. So one of the things I want to, especially first homeowner buyers, a lot of banks don't like units, say, for example, under 40 square metres. So this is another piece to the puzzle as well that comes under security. So the banks also got to have acceptable security. Some banks also don't like large lots of units as well. So certain banks will only say you're allowed to borrow 80% when there's, say, more than 50 units in the block. So security is a big piece of the puzzle.
So a big piece of the puzzle that really requires some expert guidance and management through the process, because it's a bit of a minefield.
Yeah, that's correct.
Okay. So we've covered our security and we've covered our serviceability. Your last of your super S's is the strength of character. Talk to us a little bit about what all that means. Okay,
so as I mentioned before, is it's very important to have a VEDA check. And because what the banks do now is generally a comprehensive credit report. So everyone is scored, and you can have scores up to high 900s, and anything below 600 on this credit check is deemed not acceptable by some banks. So again, it's very important to know what your credit score looks like. With that strength of character, also things that come into play are such as how many jobs have you had, say, in the last 5 years? If you ever have to go through a fact find with a broker, which you'll have to do for an application, these are the questions that need to be answered. How long have you been in employment? And they especially want to look at the last 3 years. Credit inquiries are extremely important. If you've had more than, say, 3 or 4 inquiries in the last 12 months, that will definitely affect your credit score and come to strength of character. Things like, as well, change of address and employment all affect the strength of character. And as I said before, the worst thing that could ever happen is that you have your identity stolen, and that can I've seen cases where it's very negative on your credit file, and it's really hard to get out of these things. So always making sure that when you do apply for credit, it is something that you want to do and you're not just doing it for the sake of doing it.
Okay, so we're coming back to this credit check approach and making sure that's fundamental part of our application process. The length of employment. So it seems to be more of a fact that these days people have more than one job in their lifetime. You're saying that the banks actually sort of devalue or score you worse if you've got more jobs?
Correct. It can come up because this is one of the things that comes up on your credit file. However, again, like some banks want you to be in a job for, say, at least 6 months, whereas some banks, again, will only require one pay slip. So, again, every bank has different policies in regards to this.
And you mentioned here also credit inquiries over the past 12 months. So everything we do involves a credit inquiry when it comes to finance?
Correct. So if you apply for, say, again, a Latitude credit card, a zip file, which, most retailers now allow you to do pay now, so pay later credit cards, all come up on your credit file.
They're all on your credit file.
Even if they say they're interest-free for 6 months.
Wow. So even if I go to Harvey Norman and I go 12 months interest free and sign up for that, that is a credit score, a credit card, and that's going to affect my borrowing.
Yes, and the actual limit is on your credit file.
Wow. And more so if I pay it by a day late or I miss it in any way, shape or form, change address, don't even realise, again, my credit score.
That's correct.
Okay, so credit score is so important in this whole process. And you said before, and I'll reiterate on this or just want to hone back on it, a lot of people aren't even aware when it comes to when you do a lodge an application.
Well, they just forget. They bought a fridge back in 2005 and did it at Harvey Norman and did a 3-year interest-free period, and then they've never closed it. So
it's important that they close that account, clean it all up, and then relodge or lodge with the bank at that time.
Mm-hmm.
So that was great, Sally. So in summing up, the 3 S's are the vital parts when it comes to getting that mortgage or getting a mortgage over the line. And that's the serviceability, which is your income over expenses and how much you can afford to pay a month or a year or whatever the measure is. The security and the amount of money you've been able to build up or can access as your deposit. And then the strength of character, which is you being a reliable and a strong borrower, whether it's you or a spouse or a partner, you're assessed on the strength of character, and it's vitally important to go off and get a credit score or a Vita report on your strength of character or your overall circumstances before you lodge. So do you see that as a fair summation of how it works for a mortgage?
Correct. And one of the things I'd like to just also mention is that brokers give you choice.
So it's critically important in this process to see an expert, and in this case a broker, to really present your case around these 3 S's and getting your loan over the line.
That's correct. Brokers will give you choice, and we will be able to present your application to the most suitable bank in the best light as we see fit.
Tell me a little bit probably about the current climate. We're seeing interest rates climbing or going up. Is there any cause for alarm from what you're seeing?
I don't believe so. We've been in a low interest rate environment probably for the last 2.5 years, and it's just going back to normality. So even like a 0.85% rate at the Reserve Bank has not been seen really. It's still one of the lowest rates we've had in history. There is a prediction that it might go up another 2%, but still that is fairly low if you have a look at the last 20 years of interest rate history in Australia. So at the moment, I don't believe there's any need to panic. What it's actually doing is when interest rates go up, it means the economy is in good stead. So we're trying to decrease inflation. And hopefully it will all balance out a lot faster than is originally anticipated. So already from some seminars I've been attending the last couple of weeks, that they believe the spending is starting to slow down, which is what I believe the interest rates going up it was trying to do to the economy.
So the interest rates going up is, yes, we've got to keep an eye on it and be able to manage it. But also you mentioned when the banks are working out borrowing capacity, they're adding 3% to your capacity to absorb these interest rate rises. Is that fair?
That's correct. So basically when we've had our low interest rates of the low 2%, which we've had over the last couple of years, the banks were already doing the servicing at 5.5%. So to make sure that you could afford the home loan that you've currently got.
And what about those people that have been locked in on interest-only style loans and they're now coming off their interest?
There are a lot of people coming off fixed rates that have been at, again, the low 2%. So those people will find that they won't be able to get another fixed rate of that at the moment. But what they will find is that they should be able to get a variable rate still in the 2% for the next while. And the banks are willing to negotiate on the variable rates.
So again, come to a broker who can assist you get a better rate than the headline rate. Is that fair at the bank?
Correct.
And what sort of discounts are you able to negotiate quite often for your clients?
Depending on the loan amount, and one of the big things the banks are also looking at the moment is LVRs, which is loan to value ratio. So, for example, if you have a LVR under 70%, I've been seeing discounts of 2.5% off the standard variable rate at one of the big banks. So that's, again, we're looking at a variable rate, I think in the high 4s at the moment. So we're down to the high 2s.
So from the high 4s to the 2s.
Yeah.
A 2% discount.
2.5% off the standard variable rate we've been seeing at the moment.
For the life of the loan. So by seeing a broker, you could save 2% off a standard loan.
That's correct. And as well, it will also, as I mentioned earlier, it will help towards that serviceability piece.
Oh, Sally. Wow. So in terms of a mortgage, be ready, as in get your mindset around it. You want to buy a house, you're determined. If you're determined, you can make it happen, and through a broker, they can find you the right place and get you over the line by getting your house in order and then putting the best foot forward. Get smart, get savvy, money does matter. Oh, thank you, Sally. We really appreciate your time today, and thanks for talking to us on NavTalk.
You're welcome.
Thanks for joining us today for NavTalk. You can listen to other podcasts in the NavTalk series via YouTube or where you get your favourite podcasts, or simply search NavTalk. Be sure to follow Navwealth on LinkedIn, Instagram, Facebook or Twitter. And please, if there are any particular topics you would like us to cover for a future episode, let us know via our website. I'm Simon Prowse. Until we talk again.